So today, if I'm remembering, we're talking about DSCR loans, right?
Correct. Yep.
Okay. What does DSCR stand for? It's kind of a mouthful.
DSCR stands for Debt Service Coverage Ratio, which is easy, like you said, it rolls right off your tongue. But really it's just an investor-only loan. It's only made for investors, for buying rental properties, not even flips, just rental properties. Okay. And it's a way for them to get a really good 30-year product, 30-year loan, without worrying about how long they've been in business, their income or their business income, any of those things. They could have just started in business yesterday and a DSCR will work for them. Set up specifically for investors to help investors get more properties.
And it's just for people doing rentals. Like that's what it's made for.
Just rentals. And you can't use them for flips, or they don't really work for flips. You can't live in any of the units. So anything that's short-term or long-term rentals, DSCR is perfect for it. And people like the DSCR as a long, debt service coverage ratio. I just always look at it as long as your property breaks even, that's what DSCR calculates. A DSCR ratio just calculates, does your property break even or do better? And most investors want to make money in real estate.
So debt service coverage ratio loan, just in order to qualify for that, they look and they make sure that once you have this and you have you're getting rent from the tenants and you're accounting for your expenses and everything, that it at least breaks even.
Correct.
If not positive cash flow. And then if you have if it meets one of those, then you're good.
You're good as far as the income.
Awesome.
Yes. There's a few things that it actually also looks for besides just income, but that is the main factor here is it covers for your income that you may not have or may not want to report. Like I said, or maybe just start at 1099. If you just started in business and you have less than 2 years, most lenders won't use that income. DSCR comes in and takes care of that little issue that was out there. So more and more investors can buy properties.
Interesting. Well, I'm not sure if I'm understanding. So what's the issue that it takes care of?
The issue is income. So if you're a investor trying to buy a property, they're going to look at your either personal income or your business income or both. And to use that income, you're going to have to be in business for 2 years to be able to use that income. If you haven't been in business 2 years, they're not going to be able to use your new income. You have to wait till you have tax returns for 2 years. So if you're a new investor or you like to write everything off on your taxes and you don't show any income, your taxes aren't going to help either. Even if you've been in business 5 or 6 years, 10 years, if you write everything off, which a lot of people like to do, which is their right, things that they could do, this is a perfect loan for those people who just don't show anything on their tax returns.
Okay, so I'm understanding that people can write off their business expenses, but what's the other piece that if they this loan works for people who either write off their taxes or they do what?
Or they haven't been in business for 2 years.
That was the other piece.
Yeah,
Okay.
So in business to be able to use their tax returns, because you can only use the tax return income if you've been in business 2 years. So there's a lot of people who just quit work and moved into investing a year ago, or just quit work and they want to start investing in real estate. This is the product that helps them get over that one hump, because without income in the past, you weren't able to qualify for, rental loans.
Okay, so this is a great loan for like just getting started, or if you write off all of your expenses, because the only thing it's really taking into account is, are you going to break even with this rental property?
Correct. Yep.
Okay.
Yep. So there's really 3 factors when you look at a DSCR loan. It is the income from the property, your personal credit. We've talked about this many times. Personal credit matters. The higher the score, the better the rates, the better the terms, and your loan to value. So how much equity you have in a property. So are you looking for a loan that's covering 80% of the value or the purchase price, or 70%? Of course, the lower the loan to value, the less risk for a lender, because they're giving you less money and you have more equity. So those 3 things are the 3 things that you have to qualify for this loan, is making sure the property cash flows, breaks even. And when I say break even, let's go back to that. There's only 5 things they look at, because there's not maintenance or anything. They're just looking at your mortgage payment, your taxes, property insurance, and if you have HOA or flood insurance. If you have property management or anything else like that, that does not count. Just those 5 things count against your DSCR.
So it's those 5 things when you're talking about breaking even, having cash flow.
Yep.
And then The other issues are, I mean, it's the personal credit score, right?
Personal credit score.
And then
Yep.
if you have like how much money that you're bringing for a down payment.
Correct.
Okay.
Yep.
Yeah, gotcha.
Yeah. So those things are what really, make it a little bit easier. We call them the easy loan because it's not a lot of paperwork. You're not filling out anything on employment or what you've been doing the last couple of years. So it's a lot easier loan to qualify for and the paperwork that goes into it. Now, these loans are set up just for certain properties. We talked about investment properties too, but it's also just set up for typically the majority of loans out there in the DSCR are 1 to 4 unit properties. So single family that are 1 to 4. There are options out there for 5 units and above, but they're a lot less available. So you just have to shop around and make sure. But any kind of rental property, you can find a DSCR loan or a stated. In a way, it's kind of like stating your income, because the beauty of this, we just talked about it's your rental income. But what if you just bought a property that's not rented yet? What do you do?
Yeah.
So it even goes off of what we call it, like the estimated rents in your area. So
Okay. That makes
what an appraiser does is it collects not only value on the property, but the appraiser goes out and collects all the information for rents in the area. And they say this property will rent for approximately this amount. So it doesn't even have to be rented. It just has to show that it would rent for it in that market. Even before you buy, you should be out on Zillow and rents.com and stuff and doing your own research on what the market will bear.
So you can, see how much you should expect to get in rent.
Yeah.
Okay.
DSCR is based about you breaking even for qualifying for the loan, but you as an investor, you kind of want to make sure you break even too, because
Right.
we have seen a few investors who have gone through some different classes and they bought properties and they bought them well and they got some good deals, but they're not cash flowing. So every month they're losing money because they did not do their numbers before they purchased or even refinanced. Then they find out we're losing $250 a month. That's not what we signed up for. At DSCR, the lender wants to make sure you break even. But as an investor, hopefully you're also checking to make sure you're making money on these properties too.
I mean, that's the whole reason you get into the game, right? Is you're looking for passive income.
Yeah, I mean,
potentially.
Yeah, you're looking for the monthly income plus the growth over time.
Uh-huh.
So if it's,
right.
Yeah, if you're losing money every month, that just means you're going to be working harder somewhere else
to
cover that.
Yeah.
And I don't think that's what most people are investing for is, to cover someone else's
payment. No, yeah, not most of us.